Hello and welcome to another Trades and Tutorials video. This is Jeff Fish, president of MarketGauge.com, and in this video I've got another ETF for you to keep your eye on to profit despite or regardless of what the overall stock market does. Now, before I get into the video, if you're just discovering this on YouTube, please make sure to like us or follow us, subscribe to our channel, but probably more importantly, make sure you check out marketgauge.com/tutorials for videos just like this, especially if you're interested in ETFs, because for the next couple weeks, I'm going to be focusing on different ways you can profit using ETFs. And if you don't already know, you can also make this video HD. In the lower right hand corner, there's a setting that click on that little gear. It'll give you the option for HD and the video will become much clearer. I think you'll prefer it. All right, so just a quick review. In my last video, I talked about DBA, and DBA is an ETF that tracks commodities. And my point in that video was that not that it's always going to go in the opposite direction of the stock market. So I've got the SPYs or the S&P 500 ETF at the bottom of the screen for comparison and DBA up here at the top. And my point in my last video was after a long decline here, DBA is looking like it's put in a nice base, and it also put in a pattern, which I discussed in the last video. You can go back and look at that at marketgauge.com/tutorials if you're not already there. And it started to move up over the last couple days, but I'm not saying, see, I told you so, because I'm really looking for a much bigger opportunity. I think it's just getting started. So today's video, totally different type of ETF. So you may be familiar with the VIX, the volatility index. And the volatility index is a measure of literally the volatility in the options that trade on stocks. So, or more specifically, the indexes. So it often trades in the opposite direction. So you can actually trade the VIX. It often trades in the opposite direction of the market, and it can be used as a pretty good hedge. As you can see, it rallies sharply here as the market sold off sharply. Same thing here. You can see market sells off sharply. So one of the ways to use the VIX is as a nice hedge or a way to get short the market by getting long. Now, the VIX actually itself is not the topic of this particular video either. In fact, I'm going to show you the reverse of the VIX. So the reverse of the VIX is an ETF that will trend in the opposite direction of the VIX. Now, the reason that this was actually brought to my attention is because we have a trading system that has the XIV, the reverse of the VIX ETF, in it. And so in the middle of April, it gave us a buy signal right around 39. So I guess right in here. And so the thing I want to point out here, the power of ETFs, is when you understand that you have these other options, the power of this ETF is that if the markets just go dormant, as in like going into the summer, that wouldn't be a bad assumption or a bad bet. If the markets go dormant, the volatility is going to go down, and that is going to drive this up. Now, we just took profits based on a completely mechanical approach, so I'm not picking a top in here. But if we bought this at around 39, we took profits at around 49, and so this thing went up 10 points, or nearly 25%. At the same time, the S&P went completely sideways. All right. So my point here is stay tuned for lots of different ways that you can use ETFs to make some pretty nice gains without having to frantically trade each day and without having to be dependent on what the overall market is doing. It could be because you're in another country, it could be because you're in the right industry group or sector, or it could be that you're in commodities. It might even be that you're in something like the XIV or the VIX when they make sense. All right, so hope that helps, and I'll see you in the next video.